Hello and welcome in, guys. Today I'm going to go through my bullish case on PayPal and why I've been investing heavily in it. So, first things first, we're going to start off with this crappy PowerPoint presentation I put through, just going through some of my main points of what I see in the stock and why I'm personally positioning a good chunk of my portfolio towards it. And after that, we'll go through the fun part, which, as always, go through the spreadsheet and I'll run you through some of my projections on the stock and what I expect it to do. So starting right here, PayPal, main thing, undervalued, and I think it has really good margin expansion. And that margin expansion is just going to make the net income growth, I think, be pretty good, as you'll see in a second. So, without further ado, let's get on to the next one. So, PayPal at a glance, they have over 400 million active users. They're a recognized global payments brand, consistently profitable, strong cash flow, and they're trading at historically low valuation multiples. Now, just to add on onto this, their current ratio is above 1 whenever I last checked. And right now, as we'll get into later, they're doing a lot of share buybacks, over I think 6 billion in the past year that they've done. And when you have a market cap, I think the last time I checked, their market cap is either 66 to 70 billion. When you're taking off $6 billion worth of stock and your market cap is around that 60-ish billion range, that's actually insane. Like, they're offsetting it a little bit with some of the employee compensation, but they're retiring way, way more than they are issuing, which is just going to be so great for EPS expansion. But let's keep moving. So right here, the company's currently trading at a 14 price to earnings, a forward price to earnings of 12.81. Historical P has been 35, but this is back when they had higher revenue growth and back under the past management team. Lately, it's been more stagnant on the revenue growth. They've been doing around like the 4 or 5%, that single digit range. So, of course, the valuation is going to get pulled down. Should it get pulled down all the way to where the forward's trading at a 12.8 when it has an ROIC of 20%, which is a pretty decent ROIC, return on invested capital. I personally think it got pushed down a little too low, especially when it was in that 50 range. Now it's getting a little closer to fair value, but I still think it's a good deal. And this analyst compounded annual growth rate. This is the expected EPS growth. Analysts currently have it growing at 12% through 2029 on a CAGR basis. And personally, I think this number is actually pretty low. I think analysts are being a little too conservative. And I'll run through that more whenever I get through the valuation and the projection portion of my Excel file. But whenever I was recalculating the growth, I was kind of going on a margin expansion basis, which you'll see. So they're already retiring a decent amount of shares from the open market. Like I said earlier, they were trading at like a 60-ish billion, taking off about 6 billion of shares they were taking off the market. You got to factor in some of the employee stock compensation, but I'd say probably, I think from the last report I checked, about 6% of the outstanding stocks. That's how much it was reduced by 6%, which is ridiculous because that really is just going to lead to that just going into the stock price growth and the earnings per share growth. So, yeah, more of the story there. Like, if they're already reducing by about 6%, I think they're expanding the margins. They're making more on the revenue they're bringing in, so there's going to be upward pressure on that also, creating a tailwind. Yeah, I think 12% is just way too low. I don't see how they only do a CAGR of 12% through 2029. That's I think this would be like Alex, Chris, and the team did a horrible job if they are only hitting 12%. My personal opinion, but that's what I'm thinking. And of course, the market pessimism has created a value opportunity. The stock used to be in the 300 range. 200 fell all the way, bottom out around the $50 range. It's currently trading around 70. And yeah, I mean, you could see why the past management team, like, this is why this is more of a turnaround play. The past management team they just made some decisions where they were just going for revenue growth at any cost. They weren't focused on margins at all, and they just did a lot of things that didn't make sense. A lot of acquisitions, and then just never fully integrated it with the company. So it was almost like they were just running multiple companies competing against each other. So it makes sense that the pessimism has hit, but I think that ship's turning around with the new management team. Almost the entire new management, or almost the entire management team, is new at PayPal. So I personally think this is going to be a great turnaround play, similar to some of Peter Lynch's turnaround plays. And this is when you want to get in, whenever the pessimism's there, because once people start realizing the plan's executing and doing well, the stock price is not going to be at 70. I can tell you that. And like I was saying down here, current ratio 1.33. Good thing about the valuation being low and the company having a good, strong balance sheet, just it does sort of de-riskify your investment a little bit. The lower you get that valuation you're paying for it, you're already reducing your risk. So let's keep going right here. So I already touched on this a little bit, but with the turnaround strategy, main thing being right here, PayPal World. I don't think this is going to be crazy for margins or growth. I'm not anticipating that. What I do think it's going to be is I just think it's going to make the product a better competitor compared to other ones like Cash App and some of its other competitors. Reason being is because before all of PayPal's different services, they did not integrate at all, and they all acted basically as standalone services. What doesn't really make any sense. If you're gonna be logged into PayPal, do you really need to log over into your Venmo? And then on top of that, this was a point I didn't add the slide for, but they were also talking about how pretty much everything they were routing on the digital side was coming back to the US, and then it shoot back out even if you're out of the country, which was causing a lot of latency issues on transactions, which I'm sure, I'm in the US so I never noticed it, but I'm sure overseas that was probably frustrating because it was probably maybe more unreliable as a payment provider, or it took longer and it was just a little more frustrating to use. So hopefully with this, where they're starting to have those connections being built all around the globe, so it's not all just being sent back to the U.S., that's going to make a more seamless, easier customer experience, which is just going to drive the actual retention of their customers. So down here, I also just highlighted the refocusing on branded checkout growth, which that branded checkout growth, the PayPal branded, Venmo branded, these are higher margin than their Braintree side of the business when they were doing the unprocessed transactions. And they've been talking about, the whole team has been talking about switching more to that branded growth because they can get more down to the bottom line. Now, again, like I was saying earlier, this is going to drive more consumer and merchant engagement. This is just with everything being integrated. It's just going to make the product much better to use. And then we saw the TPA branded grow by 4%. The total payments per active account. Now, as a whole, they decreased by about 4%. But the branded side grew by 4%, which I don't think a lot of people, maybe they noticed or they didn't pay attention, but this is something the team's already been talking about that they were going to be doing for I don't know how many quarters already on all those conference calls. So this should have been expected, and I like to see that there is a branded growth because that is a higher margin. Revenue growth is great, but revenue growth for the sake of revenue growth is just, it's useless. At the end of the day, the bottom line is what you want to grow. The bottom line is the best. If I can tell you you can make $100 more in sales, but your margin's going to be 10%, or you could make, I don't know, $60 worth of sales with a 30 or 40% margin. Of course, the 30-40% you're going to choose that any day. So I think I agree 100%. Focus on the branded checkout, get the higher margins, and if it's going to hurt the revenue growth numbers and the active account payment transactions in the short term, that's fine with me. Cut down that unbranded. It's a headwind right now, but it's going to turn into a tailwind as they keep going. Now, side by side with competitors, I pulled in Visa and MasterCard right here just to kind of give a comparison. And Visa and MasterCard still very strong fundamentals on them. Like if you rather go invest in those two, like respect. I'm not personally doing that, but there's what can I really say? They have really good fundamentals. Yeah, they're trading at a more expensive valuations, but look at some of these. Look, a return on invested capital of 46.6%, Mastercard a 84.09% ROIC. That's that's ridiculous. So yeah, they're trading at a 33 and a 4 to 27, a 39 and a 4 to 32. But you're gonna tell me they don't deserve that premium, and they have such a sticky business model. Like think of Visa and Mastercard. Everybody uses that. You get a debit card, you get a credit card, likely running through one of them. High probability. And people don't just have one debit card, one credit card. They always have multiple. So the likelihood that you don't have at least one card that's Visa or at least one card that's Mastercard, so low. So I understand why they're trading for a premium, and again, that's just amazing. And like, look at their net margins. The net margins is something just so ridiculous when I first remember looking into these. Like 51%, 44.9%. Amazing net margins. And their growth right now, they're currently expected 13 and 14% over the next 5 years on a CAGR basis. Personally, I'm just like, I'm shocked they're so able to grow that much. But they are, and I mean, great on them. Now, here's where I'm more of a investing in PayPal. A lot of that margin expansion, they've already they're already at 51 and 44, so they don't have as much room to grow as PayPal that's at a 14%. It's been mismanaged so much in the past. So PayPal has a real good opportunity to just grow their margins and not even get to the same levels as they are. That's not what I'm pricing. I'm pricing in they're expanding their margins to get closer. And again, a return on invested capital at 20% is still really good. Obviously, compared to these, it looks like crap, but that's nothing to sneeze at. Most companies aren't getting a ROIC at 20%, so that's still really good. And growth 12%, we already talked about how I expect this number to be higher. But even if we were to take that 12% growth at face value, okay, 12% versus 13%, is that 1.3% extra growth, is that worth paying almost double in valuation? Same thing over here about like a 2.8% growth, is that worth paying almost a 3x on the valuation? Some people maybe. I personally rather go with PayPal. I think there's a better risk reward there. But if somebody told me they were going with Visa or MasterCard, I'd have nothing to say. It would be totally understandable. Now, again, we already touched on the share buybacks earlier, so I'll go kind of quick on this. But $6 billion worth of stock buyback, that's nothing to sneeze at. That's a lot of shares to take off the market. I don't know if people realize how many shares are taken off the market. And the great thing is they're buying it at a low valuation. Like I said, the PE's 14 on the company. So if there's any time they should be going all in and using that cash flow to buy back shares, it would be right now. Invest as much as you can. Take off as much. Make my ownership in the company better. Expand that EPS. Expand that EPS through that. So then whenever the stock price does rise, now you're not just getting that push in EPS from all the margin expansion, and now you manage the company better, and we're getting back to better revenue growth. Not only that, now you get this where you reduce the share count so much that also is just having a good accretive effect on EPS. So again, big fan that they're doing the share buybacks, and as long as the stock price remains depressed over time, I think they should keep buying back as much as they can. Just keep buying back shares. Keep buying back shares. At least while it's in these lower valuation ranges. Now in closing, so why am I investing in it? I think the market pessimism has pushed the stock price down, and it started to go up a little bit, but I still think it's more depressed than it should be. And the market pessimism that pushed the stock price down has de-risked a lot of the stock. So I think it offers a decent risk reward, at least for my portfolio. It's a great turnaround and growth story, which I think we'll see that unfold over the next 5 years. I think there's strong upside if the execution continues. If they are able to execute well and they're able to get their revenue growth back to the 8 to 10% range, oh my god, that's going to be so insane. Combining that with the margin expansion and the buybacks they've already done, you could see this stock going back over 200. And then again, lower valuation, minimizing long-term downside. If it'd be a different story if they were having all this turnaround and the stock price was valued at a 25 or 30 PE already, then okay, maybe not worth it, but the fact that it's still at a 14, fine with me. So now the fun part, we got to get to the projection. So let me go ahead and pull that up real quick. And as always, some of my stuff is pretty disorganized, so sorry about that. And when I originally ran this projection, as you can see right here, I ran it when the stock price was at 67.83, almost $68. And now, as we can see, pulling in, it's about 70.19 as of the closing on Friday. So we'll go ahead and run through my different cases and why. So I guess we can go ahead and start. Let's start with the base case, which after looking at it over again, I think my base case might have been a little too bullish. I think I went a little more bullish for my base case. So if you really want a more, how do I say it, a more accurate picture, maybe if you want to look at something like a midway between my bear and base case, and that will give you a more true base case. But with that being said, I still think my base case is possible. So we have over here, base case assumes a net margin growing to 23%, while revenue has a compounded annual growth rate of 5.59%. That 5.59% revenue growth rate, so again, this isn't factoring in lots of growth rate at all. This is just the average annual analyst expectation on growth rate. So I'm taking that, and this is leading to net income growth of 15.6%, and I'm having them take off about 3.5% of share buybacks in the coming years. Which, that one obviously we could see how that goes, but with them taking off about $6 billion a year so far, and if they're able to generate stronger cash flow, they might be able to up that higher, especially if the stock remains depressed. I think that could be doable. So over here, I basically just, for anyone wondering the numbers up here, I just took the ending net income growth, and what I basically did is I projected out the revenue. I don't have it on this slide, but I projected out the revenue with this growth rate for the 5 years. Then I took that to get with a net margin of 23% to get this 9.66 billion. The 4.68 billion is the starting trailing 12 month net income. Did that, use this over here, 5 years, use this to calculate the CAGR growth that would occur over those 5 years, and that's how I got to this 15.6% growth rate that I'm using over here in this base case. So at a 15.6% net income growth rate with a low price to earnings of 20 to 25, and remember, Visa, MasterCard in the 30s. Of course, they have a higher ROIC, but that's why I still have this going lower than those two. And one more thing besides that, the net margin, they're currently at 14%, so to 23%, I don't think that's too crazy in 5 years, especially with the team focusing on that branded growth that they have been stating is way higher margin. And with their competitors doing the around 50% net margins, I don't think it's too crazy to think that they could grow their margins to 23%. So just with that out of the way, that would be a low fair value with a discount rate of 15% of 117, a high fair value of 146, low stock price after 5 years of 236 to 295. And remember, this CAGR, heads up, was based off the 67 price, so the CAGR is going to be a little lower because it's now risen to $70.19. But even then, 28 to 34%. And like I said, I used a discount rate of 15%. So if these assumptions were to occur and you bought it at 117, you'd still be getting a 15%, which I think is a pretty good. That is a pretty good ROI on your investment. So That's that one right there. Let's quickly jump over. Let's go bearish and then we'll have fun with the bull case. So, with the bear case, this assumes a net margin growing to 16.5%. Again, with these numbers, same thing as earlier. Projected out the net income, got the CAGR, blah, blah, blah. You get it. Not going to go through every time, waste time. Okay. Bear case assumes a net margin growing to 16.5%, while revenue has a CAGR of 4.75. So I'm going lower revenue growth, leading to net income growth of 7.65%, 2% share buybacks for the compound annual growth rate. Okay. Right off the bat, I'm going to tell you, I don't think this one's very realistic. Like I said, I think the best would be a middle between this bear and base. Reason being, they're already at 14.6%, so I think if they're, or 14.1% on their net margins, around that 14% range. So if they were only able to expand it by 2% over a 5-year period with all the shifts they're doing to branded checkout growth, I think that would be ridiculous, and I think that would be honestly a complete failure in the turnaround strategy of the company, given the fact that they focused so heavily on this and they made this such a priority. So if they were only able to increase those margins by 2%, especially when some of their competitors are in that 50% range, that would be, I don't want to say worst case scenario because there's one worse right after this, but that'd be pretty bad. Pretty bad. The revenue CAGR of 4.75%, so we went with lower revenue growth. And honestly, the one thing you might be able to poke holes on this one is a 2% share buyback, because given if they're able to keep their cash flow consistent, this would actually probably be higher because I assume the stock price would be more depressed because of these weaker numbers, so they might still be able to clear out 5 to 6%. But that's what I factored in for my case. So over here, 7.65% growth, sleepy growth. Like I said, they were already taking off about 6% of the shares off the market. So 7.6% growth, horrible. And given this, they should command a lower valuation. That's why I put the 14 to 17, which would give a low fair value of 53 to 64 on a 15% discount rate. So still not horrible. Low stock price of 107 to 130, and then a 9 or a 13% based on that $67 price tag. So even in the bear case, that's still not horrible. I mean, a bear case where you're still getting around a 9% return, there's much worse things you could be investing in. So even on that. Now, let's go on to the ultra bear case, and we'll move on to the fun ones. So the ultra bear case, when I want to give like a probability of this one happening, I'm not even joking. This is maybe 1%. I would be so shocked if this occurred. Like, what timeline are we living in, honestly? But, okay, so with this bear case, the revenue growth slows to 3%. Net income growth is only 3%. No margin expansion. No buybacks. Like I said, this doesn't even make sense. But maybe they got into a position where the business deteriorates so much that they cancel the share buyback program because they want to conserve capital. Maybe that's the situation they can get in. And yeah, no margin expansion with all the shift to branded checkout growth. Maybe they lose their pricing power, or or their clients in the market aren't willing to pay those higher prices. Some other competitor, I don't know, and they're just not able to expand margins. I personally think it's ridiculous that it would ever go. It would get to this level, but that's why it's our ultra bear case. We just project it out on the off chance it does happen. What do we have to lose if this were to occur? So, I have this only 3% net income growth. Lower the valuation even more, 10 to 14. Getting close to those utility valuation ranges. Low fair value 27, high fair value 38. Low stock price of 55 to 77. The stock would basically be range bound or flat for the next 5 years. Which, again, for an ultra bear case that is this extreme on the numbers going terrible, that's not a horrible CAGR for like a worst case scenario. Some other companies, you run an ultra bear case and you're looking at 50% of your capital's gone. 60% of your capital is going to be gone if this were to occur. This one remaining flat, there's worse things it could be. But let's get on to the next ones. Now, my bull and my ultra bull case, I think it could occur. Definitely going to be way more difficult. It's going to require very strong execution, but I think the bull's way more likely to occur than a bear situation, and I think it's 100% more likely to occur than this ultra bear situation. So, not to say it would be easy. This would still be tough. Like I said, most probable between bear and base, I think, is the most probable outcome. But this could still potentially happen depending on how well they execute on their marketing and how well the team executes on that branded checkout. And also something to think about is if they start making meaningful contributions through running the data to run the ads through the PayPal system. If they start making that a meaningful part of their business, that could honestly just be straight profit and really shoot margins up through the roof. But save that for another day. Let's keep going. Bull case assumes net margin growing to 30%. So still nowhere near Visa and MasterCard. I don't think, honestly, I'm not sure if they'll ever get to that level, but still pretty high, 30%. Revenue growth of 6.21%. So still not insane revenue growth, but yeah, definitely higher than what analysts have on the average. And net income growth of 23%. 4.5% share buyback is what I ran over here. My thought process right here, yes, the stock might run up a bit, but I'm assuming they're also going to be pulling in considerably more cash flow that they're going to be able to use to fund those buybacks. Obviously, this one's really difficult to project because you never know what the stock price is going to be, so how much can they retire and take off the market. But regardless with that one, we're looking at net income growth of 23%. So with that, I think a 29 to 34 would be fine for them to trade at, especially with Visa and MasterCard. While they have that higher ROIC, they're also growing at about that 15% range as we saw, that 13 to 14% range on their net income growth. So if PayPal's growing 23, I have no problem with them commanding a 29 to 34 when Visa and MasterCard already command around a 30. So I think that'd be fair, which would go give a low value today of 249 to 292, a future stock price after 5 years of 502 to 588, based on this 67, a CAGR of 49 to 54%, which is amazing. If this were to occur, let's give it up. We're all going to make a ton of money if this were to occur. Now, Ultra Bull case. This one is kind of the same as the Ultra Bear. Probably less than a 1% chance this occurs. 1% chance or less. They would really have to execute insane. But I've seen crazier things happen, so I still wanted to project this out. So this would be net margins pushing the 35%. This would be them growing their revenue by 8.5%. So let's say the marketing they've been doing with the whole Will Ferrell, as well as just any other marketing they're doing, they really are able to just grow it. And like the Venmo growth starts dragging in a lot more revenue. So that being, bring their revenue growth back up to 8.5%, getting close to finally hitting double digits again, which is going to be insane for momentum in the stock price. And this is going to lead to net income growth of almost 30%. I have 29.19% and 5.5% share buyback. The one thing I'll say is the most ridiculous on this, now looking at it, is the 5.5%. I doubt even if they were able to increase that much and generate so much more cash flow still. I'm not sure if taking off 5.5% would be realistic, because in this scenario I could see the stock price exploding to the upside. But if these assumptions were to occur, 29%, 35 to 43, I think is more than fair. The company's trade or growing at around 30%, as we saw, about double to what Visa and MasterCard are growing. And Visa and MasterCard already trade in the 30s, so I think a 35 to a 43, I think that's definitely a possible, probable range. Especially if they were going to be pushing net margins of 35%. So yeah, they should be getting a pretty decent premium. So that gives me a low of 397, a high fair value of 488, and a low future stock price of 800 to 983, which would be a 63 to 70% CAGR, which would just be ridiculous. So as y'all can kind of see, as I'm starting to get towards the end of this video, even if some of these weaker assumptions occur, it still can be a pretty decent return on investment. And that's my main thing right now. With the market, it's been positioned a lot more towards growth, and we've had a lot of run-up in the past couple of months, and I've enjoyed a lot of gains of that, but you always got to go skate where the puck is going, as that one saying always is. You can't just chase what's hot right now in the market. You got to be more forward looking than that. What's depressed right now? What stock prices are depressed right now? What is undervalued? Let me position myself here so whenever that flip happens to the other side and now investors are going to shift over to these more boring stocks and a lot of the higher valuation names get capital pulled out, that capital pulled out from the higher valuation, when they do, people are going to look for other places to put their money. And normally when that happens, they're going to look towards some of the value stocks. So that's why I'm kind of trying to position more right there. And with this one, I've just been investing very heavily recently in my own portfolio. I just think it offers a great risk reward, and I'm just trying to go heavy on it. I don't find the need to over diversify my portfolio. If I find something good that works with a great return, I find no reason to just limit myself and let me only buy this certain position sizing and hold off because it's becoming too big a portion of my portfolio. I think diversifying can kill your returns long term. If you're going to over diversify, just get an index fund. What are you doing? Like if you're going to over diversify, you're just chasing the average, and at that point you're wasting time. Just buy an index fund and you'll have more free time than looking all of this up. Only person I've been able to see do that successfully is Lynch. Only person. And even he only did that out of necessity and would always constantly complain that he'd have to follow those rules for his hedge fund, for the Magellan fund. Now, with that being said, if anybody needs any help with any bookkeeping, I have started a bookkeeping business, Wahardo & Co. LLC. Link is going to be in the description with my website, and I'll probably throw on the website right here on screen as well. So I want to thank y'all all for watching, and I hope y'all got something informative out of this and something of value. And just as always, remember, these are always just my projections. Do your own research, but these are my current thoughts on the company. So thank y'all, and I'll see y'all next time.